performs well in rise in inflation environments when the purchasing power of currency is declining. Gold holds its real value against the debasement. Commodities perform well in rising inflation with rising growth, the stagflationary environment that is most difficult for conventional portfolios to navigate. The genius of all-weather was not in predicting which season was coming. The entire philosophy was explicitly built on the assumption that nobody can reliably predict which season is coming. The genius was in owning something that would perform adequately in each season, weighted not by dollar amount but by risk contribution. Bonds are far less volatile than stocks on a daily basis, so you need to hold significantly more bonds than stocks to achieve equal risk contribution across the portfolio. This is the mathematical foundation of why the classic all-weather holds 55% bonds. Not because bonds are expected to outperform, because bonds are the ballast that stabilizes the portfolio when the other assets are volatile. For over 2 decades, this approach delivered results that were almost difficult to believe. From 1984 to 2013, a period that included the crash of 1987, the savings and loan crisis, the dot-com collapse, the 2008 financial crisis, and multiple recessions, the all-weather portfolio lost money in only 4 of those 30 years. Its worst single year was negative 3.9% in 2008, the year the global financial system nearly collapsed entirely. The S&P 500 lost 37% that same year. The all-weather lost less than 4%. That is not a rounding error. That is the difference between a portfolio that survives a crisis and one that requires a decade to recover from it. Daniel understood this when he built his allocation. He was not looking for maximum returns. He was 57 years old with a retirement horizon of 8 to 10 years. He was looking for survival. He was looking for the financial equivalent of the bunker Dalio had designed. And on paper, in every historical backtest available to him, the all-weather portfolio was exactly that. But the paper Daniel read was written for a different world. And that is precisely where our story gets complicated. The single largest holding in the all-weather portfolio is long-term government bonds. 55%, more than half the entire portfolio. This is not a small detail. This is the structural center of the entire construction. The bond allocation is the shock absorber that makes everything else work. It is what kept the portfolio stable during every deflationary downturn of the past 30 years. Here is what you need to understand about why bonds performed so beautifully from 1984 to 2020. Interest rates were in a 40-year decline. In 1981, the 10-year Treasury yield hit 15.8%. It was the highest it had been in modern American history. Paul Volcker had driven rates to extraordinary levels to break the inflation of the 1970s. From that peak, rates declined. Slowly, then more quickly, then dramatically. By 2020, the 10-year Treasury yield had fallen to 0.5%, 40 years, from 15.8 to 0.5. When interest rates fall, bond prices rise. This is not a theory. It is arithmetic. A bond paying 5% becomes significantly more valuable when new bonds only pay 1%. Investors will pay a premium to hold the higher-yielding bond. So for 40 years, the bond allocation in all-weather was not just providing stability and shock absorption. It was quietly generating substantial capital appreciation on top of its yield year after year in a way that made the entire strategy look even more elegant than it actually was. People stopped thinking of it as a tailwind and started thinking of it as a permanent feature of bonds. That 40-year tailwind ended, and it did not just stop, it reversed. When interest rates rise, bond prices fall. The same arithmetic working in the opposite direction. In 2022, the all-weather portfolio had its worst year since its creation. It lost approximately 23%. Not because Dalio's framework was wrong, not because the 4 economic seasons stopped existing, but because the 40-year interest rate environment that had been silently powering the bond allocation went into reverse. The shock absorber became the source of the shock. The bunker had a crack in the wall that nobody had noticed because it had never been tested in that direction. Daniel had built his all-weather allocation in 2019 at the tail end of the era of cheap money. His 55% bond allocation had felt safe, conservative, wise. But between 2022 and 2024, the real purchasing power of that allocation had declined significantly. Not through any bad decision on his part, not through carelessness or ignorance, through a change in the monetary environment that had not been adequately communicated to people like Daniel by the financial advisory industry that continued recommending the same allocation as though nothing had changed. This is not Daniel's fault. He was using the right tool. He was using it exactly as instructed. He was simply using it in an environment it was not designed for. A hammer is the right tool for a nail. It is entirely the wrong tool for a screw. The bond allocation that worked beautifully in a 40-year declining rate environment becomes a direct liability in a rising and structurally volatile rate environment. The tool did not fail. The environment changed and nobody updated the instruction manual. There is a deeper reason why this matters beyond the simple math of rising rates. The bond allocation in all weather was not just a bet on declining interest rates. It was implicitly a bet on a specific kind of government. A government that would maintain the credibility of its currency, manage its debt responsibly, and allow the natural mechanics of the bond market to function without interference. That bet was reasonable in 1996. The United States government carried debt at a manageable level relative to its economic output. The Federal Reserve had credibility built over decades of disciplined monetary policy. The dollar's reserve currency status was unchallenged. The government Daniel is lending his money to in 2026 is carrying over $38 trillion in total federal debt. It is running deficits exceeding $1 trillion per year at a time of relative economic stability, not crisis. The interest payments on that debt alone exceed $1 trillion annually. In that context, the implicit bet inside the 55% bond allocation is a bet on a very different kind of government than the one the original framework assumed. The question is not whether to abandon bonds entirely. The question is whether 55% is the right allocation when the 40-year tailwind has become a headwind. And when the government issuing those bonds carries $38 trillion in debt with structural incentives to inflate that debt away rather than repay it honestly. And the answer, according to the data and according to Dalio's own most recent public statements, is clearly no. The second vulnerability in the classic all-weather structure is more subtle and in some ways more dangerous because it is harder to see from the inside. The all-weather portfolio was designed to handle 4 economic seasons, but it was calibrated for a specific intensity of each season. Moderate growth cycles, moderate inflation, and moderate deflation, the kind of economic variation that characterized the developed world between 1984 and 2020, manageable oscillations within a relatively stable monetary system. What the framework was not calibrated for was the kind of monetary environment we entered after 2020. When central banks around the world simultaneously created extraordinary quantities of new money in response to the pandemic shutdown, the inflationary shock that followed was not a moderate seasonal change within the normal range. It was a structural break. Inflation in the United States reached 9.1% in June 2022. That is not a season, that is a climate shift. And the all-weather portfolio's 7.5% gold allocation, which provides reasonable protection against moderate inflation, was never designed to be adequate ballast against a structural monetary debasement of that magnitude. Think of it this way. If your house is in a moderate flood zone, a small sandbag wall is perfectly adequate protection. If your house is in the path of a significant flood event, the same sandbag wall is not wrong in principle. It is simply undersized relative to the actual risk exposure. The sandbags are still doing their job. There are just not enough of them. Daniel ran the numbers carefully. His 7.5% gold allocation had performed well in absolute terms between 2020 and 2024. Gold had risen significantly over that period, but as a percentage of his overall portfolio, the gains in that 7.5% allocation were insufficient to offset the losses in his 55% bond allocation during the same period. The two components were supposed to balance each other. In a moderate inflation environment, they would have. In a structural monetary debasement environment at the end of a long-term debt cycle, the math no longer balanced. The protection was real. It was simply undersized for the environment. This is the inflation blind spot and the classic all-weather structure. It was designed for the inflation that characterized the post-Volcker era. The post-Volcker era was defined by the Federal Reserve's credibility as an inflation fighter, by global supply chains that kept goods prices structurally low, and by a monetary system in which excess money creation was reliably contained. All three of those structural conditions have been challenged in ways that are still unfolding. The framework was not designed for the inflation that follows the end of a long-term debt cycle, the kind of inflation Dalio himself has been warning is coming. The architect of the portfolio has been publicly warning about the exact conditions that expose the portfolio's limitations. That is not a contradiction. That is a man updating his understanding of the environment in real time and communicating what he sees, while the financial advisory industry continues to recommend his 30-year-old framework as though nothing has changed. Right now, before you continue watching, think about your own allocation. What percentage of your portfolio is in long-term bonds? What percentage is in genuine inflation-protected assets? Drop those two numbers in the comments. Most people who answer that question honestly are surprised by the gap they find. The most important conversations on this channel begin exactly there. Here's what most people who discuss the all-weather portfolio do not tell you. Ray Dalio has not been sitting still. While the financial advisory industry continues to recommend the classic 55% bond allocation as though the world has not changed, Dalio and Bridgewater have been making significant and well-documented changes to their own positioning. In 2022 and 23, Bridgewater significantly reduced its exposure to traditional long-duration government bonds and increased its holdings in inflation-linked assets, commodities, and gold. Dalio has given extensive public interviews discussing his view that we are in a new monetary paradigm, one in which the traditional relationship between long-duration bonds and portfolio safety has fundamentally and perhaps permanently shifted. He has been explicit about gold in a way that is meaningfully different from the classic all-weather allocation. In multiple interviews and written essays over the past 3 years, Dalio has described gold not as a 7.5% tactical allocation, but as a core strategic holding, comparable in importance to equities in the current environment. He has pointed to the central bank accumulation of gold at multi-decade highs as a structural signal. The institutions responsible for managing the paper currency system are themselves hedging against that system. That action carries weight precisely because of who is taking it. He has been explicit about currency diversification, arguing that concentration in any single currency, including the dollar, represents a structural risk in the current monetary environment that did not exist to the same degree during the period when all-weather was originally designed. What Dalio has been describing is not an abandonment of the all-weather framework. It is a recalibration. The 4 economic seasons still exist. The principle of risk parity across those seasons remains sound. But the specific asset allocations that implement that principle need to reflect the monetary environment that actually exists, not the one that existed in 1996. Dan will read 3 of Dalio's most recent long-form public essays after looking at his own portfolio. He spent an evening with Dalio's Changing World Order Framework, his essays on monetary policy, and his public statements on gold and currency diversity.